Our company is Trader. We're now in our 23rd year of providing market forecasts for traders just like you around the world. Please be sure to read our trading disclaimer. Trading is risky and so on, and that's at the bottom of each of our website pages. So yeah, thanks again for coming, and let's take a quick look. And thanks for yesterday, because we weren't able to, we had a lot of things going on yesterday in the markets, and we just weren't able to put it together. So anyway, so a lot has happened over the last, if we take a look at a daily chart on the S&P, this is something that you could have known about. This move up, we have something that we call a conflict period, where a period of time plus certain price levels come together to create a conflict that the market has to effectively escape from. And it does that with a very large directional move, which is what we have underway in the S&P right now. So a lot really has happened, and it's been very directional, very beautiful, really nice to see these types of this type of advance. We do have indications for still higher prices coming. We've even we gave out kind of a surprising one today that could take into tomorrow to complete on the upside. And we've been we bought down at 44.90 this morning. We told everybody on the 15-minute chart, I'll bring this up for you, that if the market, we were forecasting that they would come down to 44.90 to 89 in this bar. This was the on-time bar, the 15-minute, and this was the 1 bar late. And in this 1 bar late, they closed above 89 and 90 at 90.75, and that was buying territory. And they had a very fast advance up to 45.04 and so on. And we still believe that we're just simply in a temporary corrective phase for still higher prices. Now, I don't have, because we are in positions in the market today and so on, I don't have the normal amount of time that I normally would have, but I do want to say a couple things. We do have, I know a few of you are thinking about coming to the Square Principle seminar that we have coming up, which is on the June 26th, 25th and 26th, as you can see here. Let me make sure that this is showing. Yeah. So June 25th and June 26th at the Mirage Hotel. And on that weekend, I'll be teaching you the Square Principle. We have a Square Principle webinar today where I'm going to forecast something in the markets, which I've done. This is probably my 5th time of doing that. All of them have been correct. And there have even been a couple where the forecast that we originally planned had already happened during the day. And so then we had to kind of come up with another one, even though we hadn't done enough, in my opinion, thorough work to really have the same certainty that we would normally have. And I hope that doesn't happen today again. Anyway, to register on that, just click on register, and you'll go in and it'll give you the ability to, put your stuff in, your email address and everything else right there. So that's today at 12:30. That's about, half hour, 45 minutes before the market closes. That would be something for those of you that are thinking about coming. It is limited. We are actually limiting it, partly because of COVID, but the Omicron variant, so that people are comfortable. And the room that we're in has 6 what are called rabbit pathogen machines that are mounted to the walls in the room. They're super quiet, and they process all the air in the room in 30 minutes. It's quite a sizable room. And all of that air that gets processed, any pathogen that's in that air is killed with UV light inside the machine. So if anybody in the room happens to have anything, COVID or a cold or anything, it all just gets killed in this machine. And there's 6 of them. So, and then we're also keeping it small, so it's not, like a really some of ours have been crowded, and there's a lot of people, or relatively speaking, a lot of people. So just know that we are very COVID compliant and so on. So anyway, a lot has been going on. I'm really very happy to take any questions or any comments that you have, or any forecasts that you might have for what the market is likely going to do here. We're pretty excited about the prospects of it. I do have longer term forecasts for where the market's going to be in the third quarter of this year. And I think it would surprise many of you to know where it's going to be at that time. It's pretty distant from where it is now, but I ain't telling you what the total forecast is here, but you can get it excuse me, by taking a trial or subscribing, and get our forecast for what the market is going to do. And I do want to say, for those of you that are new here today, we don't take forecasting lightly. We do an extraordinary amount of work to get the results that we get. So it's not that you just sit down and just, take your indicator out and just take a quick look at it and it's over. By the time we make a public forecast, we've done just about everything we know to do to make sure that we have that correct. So I don't mean to make it sound like it's super difficult or that we're doing extraordinary hard work, but it is work to work it out, to understand what is the most likely thing that's going to happen under a given set of conditions. And that set of conditions, as you've heard me say, has never occurred before and will never occur again. So the markets very generally can be said to repeat, because generally speaking, they go up and they go down, and that repeats. We could say a number of things generally that are true about the market. But when you get more specific about it and really move in close, there is nothing that actually repeats in the market. So whatever we're using to come up with forecasts for highly specific behavior, we have to know that the market is not repeating that behavior, and that behavior is not itself a repeat of some previous behavior. Now, a little deeper, there is something that repeats in the markets, but the repeat is energy, which can't be created or destroyed. So it is true that energy repeats. And I've given examples in the past, very evil people in the past that have done evil things to humanity. Those people die, but the energy that they put out, the negative energy that they expressed, does continue. And that negative energy, under the proper conditions, will repeat. But the conditions are different, and you don't see the actual energy. So what you see is the energy manipulating the then current conditions. And it looks different, but it actually is the same energy. So energy has that quality where and this is true for positive energy as well. And the universe records all energy. It is the maker of energy, and it is also recording it. It's a very strange subject, the subject of energy, because in the pool of energy that all energy is drawn from, there isn't even a ripple in that pool. Even if the energy that's taken from the pool is for a huge explosion, it doesn't do anything, because energy is constantly being converted, and it just goes from one form to another. The pool doesn't even have a ripple in it. So the whole subject of energy and its expression in the markets is to me, very interesting subject, because instead of looking at the markets, and what people do is they always look at the most basic way to say or to think about something. And on certain levels, that basic way is true, but it's only true on that level. On level 10, it's true to say that a bunch of people screaming and yelling and buying and selling are what moves the market. That's actually true on level 10, let's just say. But then when you move to level 9, that isn't actually true, and something else is true about level 9. Those kinds of truths are always relative to the level that they're on. Finally, if you get to level, say, 5, the truth at level 5 is dramatically different than the truth at level 9. And it's much more, I don't know if to say if it's much more correct, but I would say it's much deeper than the truth at level 10. So if somebody says, well, all the markets are a bunch of people screaming and yelling and buying and selling, that's all they are. There's nothing more there. That's actually true on level 10. So he's speaking from level 10. That's one way to put it. But at level 5, the truth is radically different than it is at level 10, and it's deeper. It encompasses more and therefore allows you to know more. And level 5 itself is a relative truth because there are deeper levels than that. And we can't say with great certainty that there's only 10 levels or something like that. But I hope you understand that something can be true, but only relative to the level that it's true on. It becomes very different later at different levels. And that's very true for the markets. I think this is true just about for anything. Science has certainly found this to be true. Don't you agree? Science has found this to be true because they thought things were exactly as they saw them. And then they said, well, that's true. It's exactly as you see them. Everything is exactly as you see it, right? And so we could say that, well, with whatever you see with your eyes, that's exactly what is true. There you are. But then somebody came along and said, but when I put this stick in the water glass, the stick looks curved, and I'm seeing that. So is it true that the stick is curved? Well, now we have a problem with level 10. Everything you see is exactly as it appears. That's true at level 10. But at level 9, say, that stick shows that there's something else going on. And now we have to take into account refraction. So everything you see isn't exactly as things are because of these other things. And then there's level 8 and level 7 and so on. And then finally, you're below the whole level of Newtonian level, which is the level of weight and gravity and mass and movement, action and reaction. And when you get below that level, things are true on that level. You can bounce a ball on that level. You can throw it and you can know what its curvature is. You can do all kinds of things with math to know what's going to happen on that level. But then later, if you go to the next level, which would be the subatomic level, none of those things are true on the subatomic level. So yeah, it's all true, except it's all relatively true, relative to the level that it's being identified on. So you should always know, and I'm sure you do, that there are deeper ways to understand and see something. And if you are quick, if you're a person that just reduces things down to a very basic thing and says, this is just what it is, that's fine. And it's even true. But there are deeper truths than that if a person wants to investigate. All right, let's see what's on your mind today about anything you'd like to talk about. I'll be very happy to address any of this. Rob, is there anything new for soybeans? Yeah, I liked what they did. We do have a forecast for soybeans that is somewhat bearish. I won't give you the full thing, but it actually goes out into like a few months out. I might be able to give a little bit more of that as we get a little more confirmation of it and so on. So thanks, Rob. Appreciate having you here. Stu is here and he says, hi, David, any new completions in gold? Don't need to know what gold will do next, or don't need to know what gold will do in April. I'm not sure if you don't need to, or I'm not sure what you're saying there, but we do have I would have to look at my thing. I'm not writing it down anymore. I have it in a thing on the computer now to make it a little easier. If gold closes above, I think it's 1900 and let's do this. Let's go over to gold for just a minute here. So we'd have to, yeah. So we're at, yeah, it's 1920. It's a little bit iffy, but if gold were to close above $1,920, that does lead to a short-term advance in gold. If they can't close above it or close, definitively below 1920, that's a weaker position. That's the best I could tell you right now. So thank you, Stu. Connie's here. Hey, Connie. And Connie says, is a down move in the S&P in the next quarter? I actually have a quarterly forecast that we've given out for where the S&P is going to be in the third quarter of this year. So I would rather leave that alone just for the time being until I'm ready to give out a little bit more about that forecast. But we do have a third quarter forecast for where the S&P is going to be, and it's nowhere near where it is now, on the upside or the downside. It's hell and gone from where we are right now in third quarter of this year. We did give out that forecast for what the direction is and even what the price will be in the third quarter, and it could come as early as the second quarter of this year. Then there's a second move that comes off of that completion for another even larger move from that, on time third quarter point. So there's a lot of big moves coming. This is a great time to be in markets, especially if you understand them and have developed your ability to trade them and to be a normal person while you're in a trade, which almost nobody can do. But if you can learn to be normal when you're in a trade, if you can learn to only be in a trade when you're normal, if you can learn to be in a trade only when you've understood to your satisfaction that something is probable, then you can do much better than perhaps how you're doing now. Being normal is a very important part of being able to do this well. Being agitated is death and destruction to your trading account. Being agitated about your position, being agitated about having a position or planning on taking a position, all are not normal postures. You should learn to be normal in markets, because when you're agitated, you're not normal and you're not going to act correctly as you could if you were normal. That's that simple. Ed is here and he says, thank you, Connie. Ed says, do you mind sharing if your third quarter forecast is higher or lower from here? I can't. I do mind sharing that right now, but I do want to say that I'll give that out later, but I have given it out. I gave this out originally last week, I think, or maybe even the week before for this, but it's kind of a surprise where the market would be. At least to me, it was kind of a surprise about where the market appears to want to be at that point, but I can't give any more out right now. But thank you, Ed. I appreciate it. And those of you that are here that are in the room and in the meetings, you know exactly what I'm talking about. Richard's here and he says, ES today's above below line 44.94, the monthly 45.26, weekly down at 43.30. So in other words, if we're above 44.94 when on the monthly close, I think is what you're saying, or 45.26 on the weekly close, or monthly 45. I'm sorry, today's is 44.94 on the daily. The monthly is 45.26 from what you're saying, and weekly down at 43.30. Got it. Thank you, Richard, very much. Appreciate that. Let me turn that off there for a second. Let's see. Timothy's here and he says, looks like the reflected wave daily breakout. If so, combined with higher time frames, the reflected wave is looking real bullish with some distance. Yes, that is correct, Timothy. You got that exactly right. If you know the reflected wave principle, you know already what reflected wave top the market is going to put in or come extremely close to putting in during this advance. And I'm forecasting they will put it in, so this is a really important, see, my favorite part of reflected wave isn't that it calls tops and bottoms. It's wonderful that it does. But and it also tells you something if the top or bottom is walked through, like this one was, this top that we just had, and the market is going to close well above it today, I'm pretty sure. So that's great. But there's another part of reflected wave that is by far my most favorite part, and it has to do with knowing that the position that the market is in is not over yet until a very particular reflected wave gets reached. And Timothy, you know what that is. Others that have reflected wave know that what that is. That to me is the easiest way to make money in the markets mechanically, meaning that without having to do a lot of deeper things, that mechanically you could know that a bottom is in and that you're going to stay long in that position until a very specific reflected wave top gets reached. And you're not going to do anything with your position until it does. And that can keep you and I in positions that we would never hold in a million years that long. Even if that long only means for some people, being in the market more than 2 minutes is a really long time. So it's not that I've spoken about having the courage of your convictions, but the courage of your conviction comes, it's not something that you work at and try to maintain. The courage of your convictions is an automatic result of understanding that a top or a bottom is in, or anything that the market is likely going to do. You get automatically, that's the prize, that's the reward, is that you get your courage of your convictions. It's not something you have to maintain. When you have the courage of your convictions, it's much easier to be normal and not all agitated. So if the market does something that it really shouldn't be doing and your position is not working out, it's not comfortable, but you can still be normal and take a reasonable loss. But if you're agitated and the position is in your favor, you're not going to do the right things either, because agitation doesn't work well with the market. Listen, virtually everybody is agitated when they're in the market. If you see people on the floor of an exchange, even though it's all electronic now, the same effective thing is happening in people's minds. They're very amped up, and they're all excited because they have the possibility of a gain that they can have. And all of that could be said to be natural, but that's level 10. It might be natural for people to get all excited when they say, I'm about to get a gain of some kind, whether that gain is a nice meal or it's a profit, whatever it is, the new girlfriend, whatever. It's a gain, and people get excited about that. And on one level, you could say that's true, A, and B, that's normal. But if you want to excel at something that most people are failing at, it doesn't take a lot to see that a lot of people are very agitated when they're trying to make gains in the market. And it's not that I'm saying to them, hey, you stop being agitated, because agitation has its own life. It only goes away when you have an understanding that exceeds its negative power. And so you have to make some efforts at becoming normal again. But you're normal in many other instances. You're just not normal, perhaps, when a gain is right in front of you. Maybe you get nervous that you're not going to get the gain, or maybe you're excited that you're going to get it. But either way, it's been my experience that my best investing is when I've already got the courage of my convictions. I've got the prize of the courage of my convictions, which is coming about through understanding the position of the market. And then I can just be in and be relatively normal and be reasonable. And then things work out much, much better. By the way, no matter what other people tell you, I want you to listen closely. And I know most of you know this. There is no value in simulating on a simulator being in the market. And the reason there's no value is because you can't simulate being in the market. You can be on a simulator and it can tell you you're in the market, but you're not, and therefore you don't have the same feelings and emotions that you would if you were in the market. A simulator can actually make you wrongly feel that you actually could be successful in the markets, but you're not really in a position to, because you are only simulating being in, and you already know that it's a simulation, and therefore your real emotions aren't in play. You don't have to go to a Zen monastery to get your real emotions to be normal. You already know what normal is. Stop agitating yourself to the point of being an enemy of a successful trade or a successful career in trading. Learn to be normal. Normal is normal. It's not agitated. And I won't go on about it, but it means a lot to me because I know that the difference now. I really know the difference between normal and agitated, and I'm not looking or interested in being all hyped up. If I'm going to be excited, here's another way to think about it. It's a little more street term. It's only about money after you make it. Think of it that way. For people who trade, it's always about money before they make it. That's everything. That's all they can think about, right? And it's always about money before they make it. And that's what they're agitated about. That's why they're not normal. And that's why they can't act well when they're in the market. So when you really are normal and you know what it is to be normal, you will do much better. You'll manage yourself much better, and you'll deal with the results, both successful and relatively small losses. You'll deal with both of those much better, and you won't just be reacting like a pinball back and forth from everything that happens. Allow yourself the freedom to explore being normal in markets, and you'll find that if you kind of use that phrase that I said, it's only about money after you make it, or a better way to say it is you could go ahead and make it about money after you make the money. So when you take the trade off and you've made $1,000 or whatever it is, $200, it doesn't matter. Then if you want to, you can make it about money. Just keep it that way. Just don't make it about money beforehand. So you can be normal. And I promise you that normal works at least 10 times better than agitated when you're dealing with your money in the market. I guarantee it. Let's see. Let's see. Okay, Timothy, thank you. Anything new for gold? Yeah, we have something on Samuel with gold, but it depends on if they close above or below 1920 today, and possibly tomorrow as well. Those of you in the room know what that is. Thomas is here and he says, now we have the micro to replace your simulator. The micro is really good. I'm glad you brought that up. The micro is a great way for you to be in the market with 1/10 of the potential emotive agitation that the E-mini brought you. Remember, I mean, many of you are old enough to know the S&P 500 used to be $500 per dollar. So if the market went up $1, you were ahead by 500. If it went down, you lost, or you were behind by 500 by just $1. Then they went to the minis, and that was 1/10 that, and that was only $50. Now we've gone to the micros, which are 1/10 that, and that's $5. So we literally are at like 1% of the original $500 per dollar E-mini. And what Thomas says is very true. The micro contract could allow you to practice being in the market with very, very little financial risk. You don't make it about money, you make it about points then. And you say, if you did well today, it doesn't matter that, 10 points is $50, right? I mean, that's what you get for being in a 10-point move. But what it really is if you did it correctly and got 10 points, you got 10 points. You traded correctly for 10 points. Forget what the dollar amount is. It's 10 points. It could be, it could be 10 times the amount that you got if you're trading in the E-mini. But you just make it about points and you practice being normal. So that's where you want to be, even if you don't know it right now. That is where you want to be, because everyone is so amped up, so tortured by trading. William is here and he says, let's see, micros are good. They're good for delivering or deleveraging your risk. Yes. And you can, although I'm not a fan of the idea, as you know, of, starting with one, and then you make $1,000, then you add another one, and because it builds an inverted pyramid where later losses at 3, 4, 5, 7, 10 contracts completely wipe out all of your earlier gains at one contract or two contracts, right? So what I prefer for increasing contracts, or utilizing the 1/10 scale, is to just simply trade in one contract for quite some time to be able to say, hey, I can actually do this, and I'm managing my losses. Because without managing the loss, then everything gets wiped out and there's no point in doing any of this. So managing the losses has to be there. Managing meaning not allowing losses to just go unchecked, because the market will teach you and I the lesson that you can hold on to a losing trade for some period of time and it will come back, and then everything's fine. And then you say, see, I kind of didn't have to take a loss. If I would have taken a loss, then I'd have to get back in and make that loss back. Yes, that's true. But the price that you're going to pay, as you all know, for not keeping losses reasonable, whatever that reasonable is that at some point you're going to be long and they're going to run them for really, really big amounts of money against you. And it's going to wipe out all of your previous trades, or a lot of them. So you have to manage the risk, which means that you say, listen, I'm good enough at this. If something goes wrong, I'll take my X number of point loss. On an E-mini micro, maybe it's 10 points or 15 or 20 points, whatever it is. 20 points is $100. But whatever it is that you need to take, you exit and you feel good about it because you've protected yourself from the wipeout. And then you go right back to working for the trade. Now, one final thought I want to give you today. I've said this many times. Most, it goes right over their head. I'm going to try it again so that you can get the benefit of this if you'll experiment with it and see for yourself. Most of what you see us do, where we forecast targets that the market is going to reach, are not developed on the time frame that we traded on. So a better way of saying that is that the somewhat or more longer term charts are what is informing us what the market is going to do. And the shorter term charts are what we're using to select entries in favor of those targets that are dictating to the market where the market is going to go. So if you can keep that in mind and understand that, you would never use a 1-minute chart and get indications from a 1-minute chart to then take a 1-minute trade or a trade based on that chart. That would not work out over time well for anybody. But if you did get longer term, and longer term could be a 60-minute, 30-minute, whatever, or much longer term, the more skilled you are, the better you'll be able to determine what the longer term is really saying. But if you get your direction for where the market's going to go from the longer term and learn to trade those indications on shorter term entry charts and so on, you will be magnificently rewarded for having done that. I can speak to that personally. I know that for a fact. So it will behoove you, it will help you to understand what bigger pictures are saying first before you jump in on a shorter term chart to say, I'm going to go make my points for the day, or whatever the statement is that you really shouldn't be saying, or thinking, because it agitates you. But if you'll understand that that longer term is what's informing your decision, if you allow it to, then your likelihood of being correct has gone up tenfold. Even if the market takes a little bit longer to get to your number or to start the move to the number, you're still operating in a much more correct way, and you will be very pleased with those results. That's why I've said to you that if you see somebody operating on some ridiculous tick chart or 1-minute chart, they don't know that they don't know. They don't know what I just told you. They don't know that they don't know. And they're going to suffer from not knowing. They just want to do whatever they're doing. Somebody maybe told them to do that. Very few people outside of what I think are more thoughtful people, very few people actually think much about what others have told them to do in whatever field. You know, you enter this world and people tell you what your name is, who you are, what you're good at. You know, people are always telling you how it is, what it is, and we swallow it whole. And you do have to develop this ability to think about what people have told you, think about what you've learned, in this particular case, a technical skill, being in the markets. Think about it. Think about what people have told you. Think about what you've read and investigate, because you may have a very unique way of understanding something if you give yourself a chance instead of just simply following what somebody else tells you. You know, when the red line crosses the blue line, then you go long. Okay, that's great. That's true at level 10. But at deeper levels, they're not going to be able to tell you about the deeper levels. You will have to find those. And when you do, you'll start to see that what I've been telling you is true. Things are true, but only relatively to the level that they're expressed on. And there are deeper levels than that. So don't be afraid to question what you've been told. Somebody told you to trade on a tick chart and do this and do that, and that's all you do. And you think, oh, that's the way it is. That's how I do it. Okay, great. But if you'll think about it a little bit, you'll realize that the tick chart is not dominating the movements in the market. It's merely reacting to what is dominating the movements in the market. And when you start to track what is dominating the movements in the market, then you can trade on those smaller time frames with a very beneficial view to completing what is dominating the market's targets. That's where I would want you to go. I won't keep repeating it. I just want you to know that if you were to understand that, you would be much better at what you're doing now than you've been in the past. And get that into your head, and you will never go back to doing it the other way. And you could say, well, but you're telling me to do something. Yes, I am. I'm telling you to experiment with the idea that I just told you. Give what you're doing a break and experiment with what I'm telling you. Give it a whirl. All right, let me see if there's anything else here. Good morning, David. Short options used correctly can take the anxiety away as well. Yeah, that's one of the reasons that we used options in our stock account that we've shown over the long number of years, because we can operate a business while still being in the markets, and they're not moving very much either way because of the time and just the way the nature of how options trade. So that's a good point. But you can get to the point where even futures contracts, you know what you're looking for, you know what you're doing, you know what you're going to do if it doesn't work. You have it all laid out, and you have the courage of your convictions because you've done the homework on that particular set of conditions, and you're interested, you're enthusiastic to be in. William is also saying, thank you for the long-term viewpoint. Thank you for the square and reflective way. Thank you so much, William. I really appreciate that. Nice to have you here. I hope that's useful for you. I don't give out anything except what I think is likely going to help you. When I'm talking to you here, I think these things are ideas that will help you. And this is not a matter of opinion anymore for me. It's a matter of fact for me. So I hope that will be helpful to you. Anyway, I hope you can be here tomorrow. If it's too busy, we won't be able to do it. But if it's free, I'll come in and we'll have a nice time. And I hope you all stay well. And I'll plan on seeing you here tomorrow, same time, for our Wednesday edition of Market Thoughts. I'll see you then.